Hey guys, Darshan here. Happy Friday. We've got a big Federal Reserve meeting called Jackson Hole in Jackson Hole, Wyoming, where all the big Fed heads meet up and sort of plan more strategically for coordinated central bank policy, both nationally and internationally. So it's something that all eyes have been on this entire week, but specifically today. Jerome Powell, the head of the U.S. Federal Reserve, is about to speak in 40 minutes here at 10 o'clock Eastern. That's New York time. And everyone's concerned with how much he's going to cut, or I should say pre-cut, pre-announced, because the actual Federal Reserve meeting, well, where they'll do that would be in September. Some people think it might be 25, 50. I think the consensus right now is up to 100 basis points by the end of the year. Not that that matters, particularly for business owners, people managing their own assets. We're more concerned with timing and then how that flows through into other markets, other assets. So, a handy key indicator that I've found over the years is lumber futures specifically. Not that widely traded, but very useful in terms of its 1 year leading indication on the federal open market policy rate. And that is telling us that the Fed, at least, and really global central banks at this point, other than the Bank of Japan, are already in easing mode as of about mid July, as we see here from last year. And that was confirmed in the Fed meeting minutes released this week. I think that meeting was July 31st. But yeah, basically all the Fed members were on board with rate cuts. And it's just a matter of when they're going to implement them, which looks like, if we look at our low in lumber, came between, we'll say, later September and late October last year. So that would be basically October this year. We can expect easier money and more dovish policy. But then it looks like we are going to get a pivot just before the election, effectively all the way into at least the end of the year. So for whatever reason, there will be tightening, it looks like, or at least backpedaling on dovish policy from basically the U.S. election into the end of the year. So something to watch out for. Um, and as far as how that may affect equities, we are in the bearish part of seasonality. So statistically, McClellan has given us a nice graph here of, I think it's from 1997 to present, minus 2020, what the S&P 5 or the Dow has actually done here. And it looks like from about mid-July to about mid-October, we can expect higher volatility and weakness in risk markets. So anything correlated with stocks is gonna correct most likely, even though we've seen this bounce after the big sell-off last week or last 2 weeks since the beginning of August. This recovery is definitely overly extended, and we can expect more selling from this point forward. So, yeah, get into risk off mode, bunker up, and take this opportunity to reduce risk for sure. And then, bigger picture, we have another very nice leading indicator, crude oil, which again, Tom McClellan has shown leads U.S. equity markets by about 10 years. In this case, I've dialed it into about 9.8 years is the current lead that we're looking at. And that shows a very large sell-off that we have just begun. So we're right around here. And we can expect continued selling through the end of the year. Interesting timing there, with potential recovery in the first quarter of 2025. But even when we zoom out here, it's still looking very risk off. Yeah, that's what can I say? The leading indicators must be respected, as well as seasonality. And while you can get brief squeezes and other kind of small micro market manipulations, in this case, keep your heads down and look to some of the arbitrages listed in my post on LinkedIn. Notably, still bullish Latin America, but bearish semiconductors and anything that's been particularly strong this year.